Hello everyone, myself Deepak Gupta, and today in this session we will be taking up two practical questions to revise our earlier concepts of marginal costing and cost volume profit, that is CVP analysis. And for this I have selected two questions, and they are one of the important questions that have been coming in the graduate level exams. And to begin with, if we see the first question here, that it is the analysis of a manufacturing company where we have been provided various cost details. That is, we have the cost of direct material, direct labor, factory overheads, distribution overheads, and administrative overheads. And normally, the direct material and the direct labor, they are the prime cost, that is the variable cost, and normally they are always variable, that is they are never fixed. So if you see the fixed column here, that it is nothing, but the overheads are partly variable and partly fixed. So how much is the variable and how much is the fixed has been clearly mentioned here. So as we have discussed earlier, that I will try to solve them in front of the question. So this is the quick demarcation. That still here we will have the first question and then we will have the second question. So if you see that we have already discussed that fixed cost should always be taken in total, because it is not a product cost but it's a period cost. So in this case the total fixed cost will be 189,900, 58,400 and 66,700. If you will see, this will come out to be around uh, 3,15,000. You can always check the calculations. So the total fixed cost of this manufacturing company is coming out to be 3,15,000. But if we come at the total variable cost, then you will see that this variable cost has been mentioned as a percentage of the variable cost, or I sorry, the variable cost has been mentioned as a percentage of sales. So as you all know that variable cost ratio, the variable cost ratio is always equal to variable cost upon sales. And in this ratio, if we take the variable cost per unit, then in the denominator we will take the selling price, and if the total variable cost is in total, therefore the sales will be in total. So here the total variable cost has been expressed in percentage as that the 32.8%, that is of the overall sales price, or we can say of the overall sales of 18,15,000 here. 32.8% is the variable material cost, 28.4 is the variable labor cost, 12.6 are variable overheads, 4.1% are the distribution overheads, and 1.1% are the administrative overheads. So if we make a total of that, then you will see that this will come out 60, 72, this will come out to be 79.00%. So the variable cost percentage in this question is coming out to be 79%. And we have already discussed that the variable cost percentage plus the PV percentage will be equal to 100. So in this case, the PV ratio can always be calculated as 100 minus 79, that is 21%. So it implies that out of the total of 18,50,000, so if we carry forward the solution here and we will solve this in the lower part, that the total variable cost will be 79% of the total sales of 18,15,000. Therefore, the total variable cost will come out to be 18,50,000 multiplied by 79%. This is coming out to be 14,61,500. And we can calculate the figure of total contribution either by deducting 14,61,500 from the total sales. So that will come out to be 3,88,500, or we can calculate it as 21% of 81 lakh 50,000. So if we calculate it that way, it will come out to be the same figure of 388,500. So it's your choice whether to calculate contribution this way or this. So in this case, we have been firstly asked. So if I carry forward in the same format, that the first thing required is the break-even sales. So the break-even sales is equal to the total fixed cost divided by the profit volume ratio. So here, because the total fixed cost was 3,15,000 and the PV ratio was 21%, so that is why the break-even sales will come out to be 3,15,000 divided by 21%, and the figure is coming out to be a total sales of 15 lakhs. So it denotes that out of the total sales of 18 lakh 50,000, break-even sales is 15 lakhs. Therefore, the margin of safety, commonly written as MOS, which is the excess of total sales over break-even sales, that is, it is equal to total sales minus break-even sales. So in this case, the total sales was 18 lakh 50,000 and the break-even sales was 15 lakhs. Therefore, the margin of safety will be 3 lakh 50,000. So we can easily calculate the break-even sales volume. So the answer for here is the break-even sales is 15 lakhs. But because we have to arrive at the profit, so we all know that margin of safety is equal to the total profit upon divided by PV ratio. Hence, the total profit here at the total sales of 18 lakh 15,000, giving a margin of safety of 3 lakh 50,000, will be equal to margin of safety 3 lakh 50,000 divided by the PV ratio, that is 15 lakhs. So here the profit will come out to be rupees 73,500 rupees. We can also calculate it in another way, where the total sales which is giving the profit, that is in this case the figure of 18 lakh 50,000, must be equal to total fixed cost plus the profit which you are expecting divided by the PV ratio. So in this case, this figure of 18 lakh 15,000 will be equal to the total fixed cost of 3 lakh 15,000 plus the desired profit which is required to be calculated divided by the PV ratio of 21%. So here, if we multiply the total sales with the PV ratio, so this figure is coming out to be 388,500, that is equal to 3,15,000 plus profit. So in this case also the profit will be equal to 388,500 minus 3,15,000, and that will come out to be 73,500. So it's the choice of the student that whether he wants to calculate the profit by the concept of margin of safety or by the straightforward formula where a particular sales will give you profit provided that the sales is able to cover the fixed cost, and that is the break-even sales. So in this case the profit will come out to be 73,500. Now, the third part says that what will be the profit if the sales either drops by 10% or increases by 5%. So in the first case, because the sales is decreasing, that is the margin of safety is decreasing, so therefore it will cause a sharp fall in the profits. And in the reverse case, where the sales is increasing, that is the margin of safety will increase, that is the contribution will increase, and hence the profitability will also increase. So if we carry on the same lines here, I have created a partition so that when we solve the second question, then we will have no confusion and we will solve it in the left part of our sheet. So in the third case, the new sales which has reduced by 10% will be equal to the old sales, that is a budgeted sales minus 10%. So the old sales that was 18 lakh 50,000 is reduced by 10%. So this figure will come out to be rupees 16 lakh 65,000. So if we say use the same formula of total sales, so here the total sales of now 16 lakhs 65,000 will be equal to the total fixed cost, that is 315, plus the desired or the expected profit divided by the PV ratio of 21%. Therefore, the profit will be equal to the profit will be equal to 349,650 divided by the fixed cost of 3 lakh 15,000, and hence the profit will come out on a reduced figure of 34 lakh 650. So what is happening here, that is the profit has decreased from 73,500 to 34 650 if the sales which was 18 lakh 50,000 has now reduced by 10% to 16650. So if you see a slight fall in the sales has caused a huge fall in the profitability, and if I express this expected in percentage, then you will find that this is around a fall of 52.85%. So a slight decrease or increase in sales will cause a huge impact on the profitability of the business, because of the simple reason that because you are dealing in the margin of safety region, therefore whatever is the sales reduction will cause a proportionate reduction in the contribution, and that will make a direct impact on the profitability, because in the region of margin of safety fixed cost becomes irrelevant. So if I show the other concept, other impact, that if we believe that the new sales will be 5% more than the old sales, then the old sales of 18 lakh 50,000 plus increased sales of 5%, so the new sales will be 19 lakh 42,500, and therefore the new profit will be 19 lakh 14,2,500 multiplied by 21% minus the total fixed cost of 3 lakh 15. So if you multiply it by 21%, then the figure is coming out to be 407,925, and the new profit therefore will be 92,925, and hence we can say that the profit has increased from 73,500 to 92,525, that is a increase of 1945, and in percentage we can show that this figure if divided by 73,500 is around 26.43%. So the increase in sales of just 5% to 19 lakh 42,500 has hugely resulted in the increase in the profits. So in this way, once a company has attained the break-even stage, the slight increase or decrease in the total sales margin will affect the margin of safety, and that will hugely impact in multiple ratios, in multiple times, depending upon how much is the PV ratio, the profitability of the business. So this is very important that once you are in the break-even after the break-even stage, your every step should result in the increase in the sales so that the profit increases hugely. So on this note, we finished the first question, and now if I move on to the second question, and this second question is one of the most recurring question from this topic, because if you see this question, we are given the sales. We are given the sales. So these figures relate to the sales, and this figure relate to the profit. But they have just shifted because of editing issues. So the sales and the profit has been given for the 2 quarters. And if we just observe the first quarter, that out of a total sales of 25 lakh, there is a resultant profit of 2 lakhs. It itself denotes that the company total sales of 25 lakhs is including the margin of safety. हम क्या कहना चाह रहे हैं कि अगर 25 लाख की सेल पर 2 लाख का प्रॉफिट है तो कंपनी ब्रेक इवन कर चुकी है। कंपनी की जो ब्रेक इवन सेल्स है वो 25 लाख से काफ़ी नीचे है, और 25 लाख से काफ़ी नीचे की सेल्स का मतलब ये हुआ कि क्योंकि कंपनी मार्जिन ऑफ सेफ्टी स्टेज में है, क्योंकि कंपनी मार्जिन ऑफ सेफ्टी के स्टेज में है, इसका मतलब अगर आपकी सेल्स और बढ़ गई, 25 लाख से बढ़ के 30 लाख हो गई, तो आपका सिर्फ और सिर्फ मार्जिन ऑफ सेफ्टी बढ़ा। तो ये जो 5 लैक्स की फिगर है, ये इंक्रीज इन द मार्जिन ऑफ सेफ्टी है, और उसके कारण अगर ये प्रॉफिट 2 लाख से 4 लाख हो गया, तो जो ये प्रॉफिट बढ़ा है ये कंट्रीब्यूशन के कारण है। तो हम ये कह सकते हैं कि ये जो इंक्रीज हुआ है प्रॉफिट का, ये एक्चुअली में इंक्रीज इन कंट्रीब्यूशन है, प्रोपोर्शनेट टू द इंक्रीज इन द सेल्स ऑफ 5 लैक्स। सिंपली स्पीकिंग, ये 2 लाख रुपए 5 लाख रुपए का कंट्रीब्यूशन है। And this concept gave rise to a new formula that PV ratio, though till now calculated as a ratio of contribution to sales, though now calculated as a ratio of contribution to sales, but it can also be shown as the increase in profits. Or instead of the word increase, we can write the word change, because if it's a decrease, vice versa case, then it also stands the same. So we can say that it is change in contribution to change in sales. And because this contribution has changed because of the profit, therefore instead of writing contribution, I can say change in profit upon change in sales. So we have a new formula where PV ratio can also be calculated by the change in profit divided by the change in sales, and therefore 4 minus 2 lakh divided by 30 minus 25. So this comes out to be 0.40, that is 40%. So we can say that the PV ratio is 40%. So we are able to solve the second part, where we can now say that the PV ratio is 40% and it is duly justified with the reasons. So how? That's how. So why we have done the the second part earlier, because until we know the PV ratio, we won't be able to calculate the periodical fixed cost. Why? Because now when we know the figure of PV ratio coming out to be 40%, we can also easily say that variable cost ratio, as discussed earlier, will be 100 minus 40%, that is 60%. So if I take the first quarter, because the total sales is 25 lakhs and the VC ratio is 60%, therefore the variable cost is 60% of 25 lakhs, that is 15 lakhs. And because the total profit of the business was 2 lakhs, so we can say that the total cost will be equal to total sales minus total profit, that is 25 minus 2, that is 23 lakhs. And as total cost must be equal to total variable cost plus total fixed cost, and all these concepts have been discussion on our earlier sessions. This is just the practice question, so we presume that all these fundas are known to you and they have been understood by you by watching our earlier sessions. So we can say that the total fixed cost here will be equal to total cost minus total variable cost, that is 23 minus 15, that is 8 lakhs. So this total fixed cost of 8 lakhs, because have been calculated on the quarterly data, denotes the quarterly fixed costs. Denotes the quarterly fixed cost. And because fixed costs are period cost and not the product cost, therefore even if the second quarter where sales have increased, profit has increased, but still the fixed cost will always be 8 lakhs. So for each of the quarter the fixed cost will be 8 lakhs, though the total variable cost, which was 60% 25 lakhs, that is 15 lakhs in the first quarter, will be 18 lakhs in the second quarter, being 60% of the 30 lakhs. So you can easily see the total fixed cost of 8 lakhs here and 18 lakhs here gives the total cost, which was 23 lakhs here and 26 lakhs here, and it justifies the figure of the profit, that sales of 25 lakh deducted by total cost of 23 lakhs gives the profit of 2 lakhs, and the quarterly sales of 30 lakhs deducted by the total cost of 26 lakhs gives the profit of 4 lakhs. So we can easily prove all the notions and concepts of the marginal costing, where we are clearly seeing that increase in the sales does not affect the fixed cost of the business but increases the variable cost, and therefore though total cost is increasing but it is not increasing in proportion to the sales, and whatever is the increase in the sales multiplied by the PV ratio denotes the contribution. So the contribution जो पहले वाले केस में 40% था यानी कि 10 lakhs था, वो दूसरे वाले केस में 12 लाख है, तो जितना इंक्रीज इन कंट्रीब्यूशन है वो सारा का सारा प्रॉफिट में पास ऑन हो चुका है. सो वी हैव been discussing and saying this in our theoretical sessions, that once the stage of margin of safety is attained, whatever is the increase in the contribution or whatever is the decrease in the contribution will be directly reflected in the profitability of the business. So on this note, I just move on to solve. So we can now say that the first part, that is the quarterly fixed cost, will be 8 lakhs, and that is the answer. So now we will move on to the third part and finish this session. So the third part says, okay, sales required to earn a profit of 5 lakhs during the third quarter. यानी कि थर्ड क्वार्टर में अगर हमारा पीवी रेशो सेम है यानी कि 40%, हमारी क्वार्टरली फिक्स्ड कॉस्ट सेम है यानी कि 8 lakhs, तो 5 लाख के लिए टोटल सेल्स कितनी चाहिएगी. सो एज वी यूज्ड दिस फॉर्मूला, दिस सिमिलर फॉर्मूला कैन बी यूज्ड हियर, presuming that the total fixed cost quarterly remains same, being not affected by the production or the output. The PV ratio will remain same because that will change only there is a change only if there is a change in the selling price or the variable cost per unit, and because the company expects a profit of rupees 5 lakhs, therefore the sales to generate the desired profit of rupees 5 lakhs must be equal to the total fixed cost, that is 8 lakhs, the desired profit, that is 5 lakhs, and multiplied by the PV ratio. So in this case the fixed cost of 8 lakhs and the desired profit of 5 lakhs will be divided by the PV ratio of 40%. So that will become 13 lakhs divided by 0.40. और अगर आप इस desired sales को calculate करोगे, so that will come out to be 13 lakhs into 2.5, and that is 33 lakh 50,000. So that we can say that to earn a desired profit of rupees 5 lakh during the third quarter, the company's sales need to be increased to 33 lakh 50,000. 33 lakh 50,000. So this increase from 30 lakhs to, so in the third quarter, if I write here, if we increase the sales to 33 lakh 50,000, the profit will become 5 lakh. And if you can see, this increase of 350 multiplied by the PV ratio will come out to be 1 lakh extra. So I just check the figures again कि कोई mistake calculation की ना हो. तो 13 lakhs divided by 0.4, sorry, this is coming out to be 32 lakh 50,000. Calculation mistake little. Please, this increase of 32 lakh 50,000, यानी कि 30 लाख से बढ़कर 32 लाख 50,000 पे प्रॉफिट आपका 5 लाख हो जाएगा. यानी कि ये जो इंक्रीज इन सेल्स हुआ यहाँ पर 2 लाख 50,000 का, इसका अगर आप 40% करेंगे तो वो 1 लाख ही है, और वही आपका इंक्रीज इन द प्रॉफिट हुआ है. So hence, all the credentials and the principles of the marginal costing seems to be understood. And please, these figures have been written in close contact to the question, just to analyze that the data here was for two quarters, and we have created the data for the third quarter also. So we can summarize that when the sales was 25 lakhs, the profit was 2 lakhs. When the sales was 30 lakhs, the profit was 4 lakhs. When the sale was 32.5 lakh, the profit was 5 lakh. It means the total cost here was 23, here it was 26, and here it will be 27.5. It means the total fixed cost presumed to be same in all the quarters. So whatever is the sales increase has also resulted in the increase in the variable cost, which in this case was 15 lakhs, in this case it was 18 lakhs, and in this case it was 19.5 lakhs, with the PV ratio remaining constant at 40% because the variable cost ratio has remained constant as 60%. So it analyzes that if in any quarter there is an increase or decrease in the variable cost, then it will affect the PV ratio, and here and then the whole concept of the profit calculation and the fixed cost calculation will change, and the solutions will be done separately. So I hope these two questions were of help to you, and if you practice these questions with a true objective, with true efforts, then they will be of much help in your exam. On this note, myself Deepak Gupta, logging off. Thank you very much.